According to ICT, the New York session runs from 7 a.m. to 10 a.m. But within these 3 hours lies a very specific, powerful time window that can help you catch insane scalps and day trades. And after 7 years of trading, I've come to call this the golden hour. Here's how it works. We break down the New York session into two key hours, 7 a.m. to 8 a.m. This hour acts as our range setting period. 8 a.m. to 9 a.m. This is the golden hour where the real action happens. Now, during the first 7 to 8 a.m. hour, price typically consolidates to build orders. But then as soon as the golden hour hits, price goes into action, sweeping the range low, dipping into a discount to set up the perfect entry to target the range high. This is time meeting price. Using the golden hour system, you can master scalping the New York, Asia, London, and London close because every single session has their own golden hour. Let's break down the golden hour over a real chart so you can better understand how to exactly use it to catch insane scalps and day trades. But actually, before diving into the charts, what you need to understand about trading the golden hour is that it's just a setup. What that means is you need a thorough understanding of how each of its components work and how the stage leads to the setup. So what I've done is I've divided this particular segment into two parts. Part 1, the setup. Now the best way to explain it is to divide it into two further parts, time and price. So time as in the kill zones, then price as in the components that go into making the golden hour truly remarkable, such as the consolidation, liquidity, and premium/discount. See, you're first going over the x-axis to understand the timing bit of it. Then you're going over the y-axis to understand the exact pricing bit of it. And once that is done, we get into part 2, which is the stage as in my engulfing bar play. This is the flagship system I built after many years of trading under several mentors like ICT and Tom Dante for nailing daily buys with over 88% accuracy. This serves as the prerequisite to trading the golden hour, meaning before you trade the golden hour, you do this. Why? Because as part 2's name suggests, the engulfing bar play sets up the stage for the golden hour to shine by telling us which direction it's going to form in. And as I said in the beginning of this presentation, if you're paying close attention, that the golden hour is just a setup. It works, but if you don't know what you're doing with it, you can easily end up treating it like how you treat trading chart patterns, overdoing them and finding out later with a blown account. But enough said, let's dive into part 1, the setup. So time, kill zones, what are they? You see, ICT forms specific time windows and called them kill zones. First, you have the Asian kill zone, which is from 8 p.m. to 12 a.m. Then you have the London kill zone, which is from 2 a.m. to 5 a.m. And after that, you have the New York kill zone, which is from 7 a.m. to 10 a.m. And finally, you have the London close kill zone, which is from 10 a.m. to 12 p.m., so right after New York. Now, price-wise, Asia typically consolidates. Then London typically manipulates. New York usually expands or continues after that. And lastly, London close caps the daily trading range. But the problem is, and how the golden hour came to be, is inside these kill zones, you have certain hours that work in certain types of ways. What I mean by that is you have the range setting hour, then the golden hour. Take New York for example. It runs from 7 a.m. to 10 a.m. But if we dive deeper into it, we realize that the 7 a.m. to 8 a.m. hour is usually where price consolidates to build sentiment and orders. See, during this hour, how a consolidation works is that you'll have people eager to bet. Bet on which side the market is going to expand towards. Will it be up or will it be down? The betting is them placing down orders which builds liquidity. So as soon as the golden hour hits, price immediately goes into hunting this liquidity from a premium to a discount. It first goes into discount knocking out sell stops to set up the entry, then it goes after knocking buy stops to complete the setup. But I know what you're probably thinking by now. That all makes sense now, Omar. But how do you tell which direction the golden hour is going to form in? What's the daily bias? See, this is where the stage that is my engulfing bar play has your answer. Here's a short clip of how it works. Essentially, when we're trying to identify the daily bias, our main job is to predict what the next daily candle will look like. Would it be an up candle or a down candle? And this is where the engulfing bar play excels. The best part is that there are just two rules to follow here. Rule number 1, take out the prior candle's high. Then rule number 2, close below the prior candle's opening. making the engulfing bar play the simplest way to identify daily bias. But why these two specific rules? Because see, when we take out the prior candle's high, we're taking out the liquidity above it, knocking out whoever stop was placed there in the process. And then when we close below the prior candle's opening, we gain momentum. That follows through on the next candle, identifying the bias for it. This works both ways, bearish and bullish. Now, with that out of the way, let's go over the two types of conditions you'll be using the golden hour in. Hey guys, so if you're watching this video right now, I just want to take a quick moment to tell you guys that if you're interested in joining my Telegram group, 100% free, where I have additional video topics I talk about in this video and in all my YouTube videos, the concepts I've used to make well over multiple six figures in payouts, then make sure to join the public Telegram below. It's a free Telegram. It has all the different types of concepts I use. I showcase it during the real market conditions as well. So if you're interested, make sure to join that. And back to the video. So here we have an example on the Euro USD. So let's go ahead and I'm going to break it down. So this is the 4-hour time frame, and we're going to go ahead and create a bias from this chart. Now, if you guys have studied any of my content, you know I trade structure and I know I trade structural patterns. Now, whenever we're looking for a bearish impulse, as the euro has over here, we have this swing high down to the swing low, and this run up essentially cleared a bunch of liquidity. Now this is the 4-hour time frame, so you can see that there was a little bit of a consolidation. The market ran the liquidity above it into this imbalance, and we had a big displacement leg lower. So we know that the market has now this swing high, this swing low, and now we know that we're going to be in this trading range. So now we understand this. Inside of structure, typically the market will come back into some sort of premium in this area. So we draw the swing high down to swing low, and we know that the market is going to come above the 50% mark into 62, 70, and then we can look for any types of imbalances, order blocks, etc. So in this example, we have this area that we can label out in here, and I'm going to go ahead and remove this. Now, as price reacts over here, I want us to focus on this fact. When the market forms a potential lower high inside this fair value gap, we understand that the next draw on liquidity or the next objective is potentially this low. Because again, guys, when it comes to structure, right? Like let's just say this basic structure pattern that people typically, you've probably seen at some point. If the market forms a lower high, meaning that this high is lower than the subsequent high of the range, we're going to see that the market ultimately makes a new low. So that is a low that's formed in here. As well as if there's any sort of like higher time frame level, like on the daily time frame, there's something that's present there, that just adds more confluence. Now I want us to have, now we have that the bias, we have the draw on liquidity. I want us to understand and look at this in specific day. I want to show this fair value gap that is present in here. And we're going to go ahead and we're going to break this down further. So that way we understand two things, right? We have a key level, we have a draw on liquidity. And now what we're going to do is we're going to go down to the lower time frame and identify a potential setup using the golden hour. So let's go ahead and let's go on the M15. So now in this example, we have that 4-hour fair value gap that's present. So this right here indicates, and I'm going to show you guys the time window. This right here is from 7 o'clock to 8 o'clock. So we actually had the golden hour during the New York session. Now a big part of the golden hour, and as you guys can see, right inside this time window, we form a specific swing low. The market trades back higher, and even here in London, you see that there's some sort of reaction up in here, up into this fair value gap. So we see that around these ranges, the market does have certain reactions. Now, there was news on this specific day at 10 o'clock. So we're going to look at what happens when the market clears out the golden hour going into the London close. Price runs up. And again, this is what I mean by we need to have some sort of draw on liquidity. We've also created liquidity that's resting beneath these specific lows. And we have our 9 to 10 o'clock range. We have 10 o'clock where the market comes into news event, and then we have a displacement move lower. Now, some people might ask, hey, like, how would you enter something like this? You can enter on the M5 or M15, but then but in this example, we do have this little bit of an inversion. So where there's a bullish market, bullish fair value gap on the push up, the market potentially creates a high. This is the key element, is the variables. And then if we go down further, we see the market has this expansion move lower, down into that lower low on the 4-hour time frame. Now, if you really want to get granular, you can even go on the 5-minute time frame for this, and we can see, is there potential entries? Now, we have that inversion in here, but we can also see that there was fair value gaps that were present once the market cleared out this range. Again, look at the consolidation. You even have one in here. So look at this consolidation during the New York Open, where the market drops lower, clears the 7 to 8 a.m. range, piles up. Now, a big part of the golden hour that I was talking about, trading it during the New York Open, is I'm more inclined to trade if there's news at 10. I'd rather trade the London close setup. Nonetheless, even the New York gave a nice OTE entry from this swing low to swing high up to that fair value gap. Now, again, if you're looking for the bearish side of things, though, with that draw on liquidity, we can then use this. You see that the market forms a bearish order block. The market tries to push up one more time. We have another bearish candle displacement. We also have this fair value gap that is present. So if we draw that in here, we have this order block that's also present with this fair value gap. The market comes up, breaks back below, and we start to see bearish prices until we have that liquidity pool swept. So again, guys, this is what I mean, time and price theory. Now imagine this. Imagine you're able to create a bias on a daily basis, and you're able to look at the market with these 1 hour time windows. This gives such a significant edge because now you don't have to be in front of the charts all the time. You can come in the charts looking during this one specific hour and look for very specific signatures in price that align with some sort of bias. Now, let's go ahead and let's take a look at a second example. Now, here we have an example in a chart on the dollar US GBP USD, and this is on the daily time frame. So as we see in this example, the market has a big run lower down to this liquidity pool. And on this specific day, this was Thursday. So we have this candle right here, Monday, Tuesday, Wednesday, right here. So Monday, I'm sorry about that. Monday, Tuesday, Wednesday, Thursday. So we understand, if you guys understand weekly profile, that there's a very high likelihood now that the market has swept some sort of liquidity that we can see some sort of move back up into the range. Especially if we see some sort of confirmation. So understanding that and having that specific bias, what we can do is understand that we have a discount level. Now, what we're going to do is we're going to look at an intraday setup in order to see and identify potential plays that we can look for reversal patterns. And then what we want to do is identify on the run lower, where are an imbalance points. So we have a fair value gap that's present here. And we also have a fair value gap that is present here. Now, why is this important? Because it's very important that if we get some sort of reversal sign here on the lower time frame, we have clear objectives. Now, typically, if I look for a setup on the M15 or the hourly, I'm looking to take profit at some sort of 4-hour level or a daily level. That's typically what I'm looking for. Now, let's go ahead and we're going to look further down into this setup now that we have our ranges marked, and we'll see, do we see something of any significance? So the market heads lower. There's nothing here so far. And then what we're going to see is, let's identify during the New York session. So during the New York session, I'm going to go down to the 15-minute time frame because now things are a little bit more interesting. We have the market, so we have our objectives, right? Neither of our objectives have been met. Now, inside the golden hour, it does rate above and it does rate below. However, look at how this candle right here at 8:30 forms right at 8. This candle at 8:30 forms the potential low. Now, where does that low form? Inside of this overall push up. So the market is now giving us a potential push up. This is potentially the swing low that's going to form, that's going to maintain the marketplace. And what we're going to look for is potential displacement once the market hits this level. And we quickly get that where the market comes down into here. Again, right at that 8:30 mark. That's what I want people to understand. Yes, the golden hour is from 8 to 9, but here's a big nugget that I talk about with my students as well. 8:30 is typically when the market will form the specific low in bullish sessions. The market then has a displacement above, and we form this order block. And when we have that opening price, that's labeled in here. And as we play this further, we see that the market ultimately hits the objective 1. And we'll see, does it respect that fair value gap? It does. Price then starts to push. And then we hit that second objective up in there. And then we fizzle out going into London close. That's why around London close, typically around 12, that 10 to 11, went a little bit right after 11:15. But that's why typically, if you look for any types of longs during the New York session, you really want to get out around that 10 to 11 o'clock hour just to avoid a potential drop lower. And we took out the Asia range high, so that's also another reason to look to exit the marketplace. Now, I'll give you guys a few examples during the New York session because I personally trade during London close and during the New York Open. If you guys want more videos on the golden hour and you want me to illustrate more examples, make sure to join my public Telegram. I typically do a lot more educational videos there. The YouTube videos are more in a professional manner, but sometimes I'll go off the cuff and talk about it more on Telegram with presentations. So if you guys enjoyed this video, make sure to subscribe. Let me know in the comment section if you want me to post another video, a part 2, showcasing more examples during the London Open. And if you guys enjoyed the video, make sure to share with someone, and I'll see you guys next video.